We'll go on to our first speaker straight away, which is Graeme Doole. Now, Graeme is the principal economist for DairyNZ, currently leading the DairyNZ economics team based in Hamilton. Graeme is a former professor of economics at the University of Waikato. His family have a long-standing association with New Zealand agriculture, as they have bred Romney sheep in New Zealand since 1863. So that's going back a little way. I guess the only blemish on Graeme's character, though, is that he very readily admits to being a Blues rugby fan for the last 20 years. He's obviously well known for his optimism. I'm just not his ability for economic forecasting. However, we're going to throw it over to Graeme now to sort of start his presentation. And Graeme, your topic, your presentation is on efficient dairy farming. So what do you mean by efficient?
You know, that's one thing that I often encounter, actually, Phil, especially with farmers. You know, everybody thinks about efficiency in many different ways. One of them is how much, you know, kilograms of milk solids we have per employee, or how many cows per employee. Sometimes, you know, milk per hectare is a measure of efficiency. But when we talk about economic efficiency, the measure I like to use or think about is what we call the operating profit margin. This is a measure that might be new to some people, but it's been in dairy base for many years now. It's the ratio of operating profit and gross farm revenue. For example, if I was earning operating profit of $2,000 a hectare and my gross farm revenue was $6,000 per hectare, it's just 2,000 divided by 6,000 is 1/3 or 0.33 or 33%. Sometimes we think of operating profit margin as a percentage. When we interpret it, we're saying the standard interpretation is how much profit we earn for every $1 of gross farm revenue that we're producing on our farm. So if we have an operating profit margin of 33%, then that's 33% of every dollar that we're producing in revenue, we're earning as profit. And this is a very versatile measure. It can be computed per kilogram milk solid, per cow, per hectare, or per farm. Per hectare or per farm is the most meaningful or the most insightful, especially when we benchmark that. It can be negative. So when we think about typical values for the sector, if our operating profit margin is negative, it means that our operating profit is negative. So we don't want it to be down there too often. If it's around 10 quite regularly, then, you know, really that shows us that we want to be looking at some of our benchmark KPIs and seeing ways we can improve the operating profit margin. The New Zealand average is around 25. My impression is that if it's above 30, but especially above 40, you know, that is legendary status in my eyes. Like when we look at people who are winning, you know, the leading awards in the dairy industry, we often see a operating profit margin up around 37, 40%. So that's I find it's a very good measure of efficiency. So I'd just like to move over now to our first poll, actually. Phil?
Yep, sure.
Hamish will just put that up in a second. The question I just want to ask here is how did the audience or the people listening or watching, how do they think efficiency has changed over the last 30 years in the New Zealand dairy sector? You know, if we think of efficiency as that operating profit margin. Has it decreased at 1% a year, improved at 1% a year, improved at 2% a year, or not changed at all? Well, we're seeing a little bit of activity there. At the moment, we've got neck and neck across the last three, so nobody's saying it's decreased, which is nice. Oh, now we're starting to get a bit of action.
You spoke too soon, Graeme.
Oh, so people can see it as well. That's good.
Yep.
So we might just stop it there anyway. So where we have is we've got 38% saying it's improved at 2% a year. About a third have improved at 1% a year. Around a quarter have said it's no change. That's actually a really interesting result when we look back. And it's actually, sorry, I just have to take it out. Yep. It's actually a really interesting result. If the people, if you said no change, that's actually a the people who said no change, they were actually the most correct when we look back at our evidence. something that we've done for the last decade. If you look at the Economic Farm Survey, you'll notice a very static level of efficiency. But when we look at operating profit margin, we see the same thing. And Mark's been involved in some recent work as well in Australia, where they've looked at productivity, and we find the same trend for Australia is that we are efficient users of our inputs. However, our efficiency growth has been stagnant for the last 30 years. So if we look here on this graph, we have operating profit margin on the vertical axis, we have year on the bottom. We see on the 30 years, it's really quite flat. There's a lot of volatility, especially as the milk price moves across time. However, basically we have been stagnant, and I think that is actually, this is for the average farm. I think this is actually something that we can improve on, and that we need to improve on, especially as environmental limits start to show up in our world.
Graeme, I guess operating profit margin is potentially not something that has been a big KPI for our farmers in the past. So why are you considering it now to be an important factor to a farmer?
That's a really good question, Phil, and thanks for your patience there. I'm sorry with our technical facilities here sometimes are a bit lagging here.
Well, you are economics men as opposed to technical men, so yes. I guess we can put up with that.
You'd hope we were better than what we are at this technical stuff, Phil. But maybe being a blues fan, maybe people would be a little bit forgiving on that. After all, I am patient. But But your question's a good one. Why should we care about the operating profit margin? The biggest thing is that it's strongly related to operating profit. Like we see here, there's actually a narrow grey line around that blue line, which shows a very strong positive relationship between operating profit per hectare on the vertical axis, the one that goes up and down, and the operating profit margin on the bottom. Each of those grey dots is a farm, and what we're looking at is a very strong upward trend. If you've got a high operating profit margin, you've got a high operating profit. And that makes sense given how we computed it when we look back at the last slide. The other thing is that it's actually related to the gross farm revenue, which is our, dominated by milk production per hectare and our milk price. There is a relationship there. It is positive, but it's not the strongest. If you look at the grey line, this blue line here is the line of best fit. But if we look at that shaded area, that's a 99% confidence interval. What that means is that if we resampled this 100 times, 99% of the time, that line would be in that shaded area. So that's quite wide for gross farm revenue compared to our previous slide. And the reason that is because of the looser relationship. You see there's a lot of variation here. And so really what's driving our result is not how much we produce, per hectare, not the milk price so much, but really it's coming from that operating profit as a whole. Another interesting result is that a higher operating profit actually means less variable profit. So this is data collected for 300 farms over a 5-year period. If we look at the vertical axis, the one going up and down, it's the variation in profit. The variation in profit measured through what we call the coefficient of variation. And along the bottom, we have the operating profit margin. The coefficient of variation tells us how much variation there is relative to the mean, or the standard deviation as a percentage of the mean. What we see here is that as operating profit margin increases, we see the variation come down. That shows us that variation is across time. So here, these 300 farms, we had data for them for each of those 5 years. And what we find is that farms that have a high average operating profit margin have a much lower variation in profit, which is, a new finding, but one that's very important given that we're focused on resilient systems.
Graeme, the environmental footprint of dairy farms is a huge thing nowadays. How does operating profit margin fit in with that? How does it help?
It's actually a really good question, Phil, because, I work very much in that environmental space, and we see a lot, limits, talk of environmental limits with regards to nitrogen leaching or greenhouse gases are being talked about quite regularly, particularly in the context of New Zealand dairy farms. How I see it is that if a farm is losing a certain amount of nutrient, they're losing nitrogen leached from the farm, then I think what we should be looking to do is really maximising the profit associated with that kilogram of nitrogen lost. And what we see here is a very strong indicator. Operating profit margin we see is a very strong indicator of how much money we're earning per kilogram of nitrogen leached. And these farms here, these are 500 Waikato farms. What we had is they leached everything from about 20 kilograms of nitrogen per hectare right up to over 100. And so once we control for that, even though there's such a broad spread of nitrogen leaching per hectare, we still get this very strong relationship between operating profit margin and environmental efficiency as measured by profit per kilogram of nitrogen leached. And the same goes, and it's actually a tighter relationship in terms of profit per tonne of carbon dioxide equivalent. So when we measure, that's our standard measure for greenhouse gas emissions. If we want to make the most of if we want to earn the most money we can from 1 unit of environmental footprint, then the operating profit margin is a very good indicator of our ability to do so. There is some variation, however, that strong positive relationship really reinforces our ability to use our environmental resources efficiently.
Yeah, so with the operating profit margin there, Graeme, you potentially introduced a new topic, as it were, to a number of our participants in tonight's webinar. So what's the sort of thing that drives an operating profit margin?
Yeah, that's a really good question, Phil.
Profit, what about the margin? Yeah.
Yeah, that's a really fascinating question, Phil. And I thought before I actually go into some of the evidence that we've been looking at, maybe we put it back to the audience in terms of another poll.
Great idea.
Yep, so I'll just give Hamish a second to post that now. So the question here is, which action is most strongly related to the operating profit margin? And there are 4 options there.
Two popular answers coming through there, Graeme.
Yeah, that's really good. You know, honestly, that's a they might have. They're.
Are you giving people the answers?
Yeah, yeah, I think they've looked at the back of the book like I used to do in maths, Phil.
They're all on their DairyNZ app on their phone, I think, obviously.
Yeah. Yes. No, so we've stopped polling there, and we've got 65% or two-thirds basically highlighted operating expenses per hectare, and 1/3 highlighting pasture and crop eaten. And you know, they really are. If we could have an ideal result to that survey, it would be what's shown there, Phil. Actually, yep. I'll step through and actually show some of the evidence that we have to really back that assertion up.
Sure thing.
Yep.
Yeah, should just put somewhere in there.
Yep. Yep. Here we go. Yeah, this is the evidence for the relationship between operating profit margin and stocking rate. So here we have that stocking rate on the vertical axis again, cows per hectare. We see that quite broad shaded area shows us that there is a lot of variation, but also we see that it's flat. You know, there's really no relationship between stocking rate and operating profit margin. We see this with production system as well, and to milk production as well, to some extent. We saw it with gross farm revenue before as well, is that really stocking rate is not a driver of operating profit margin. We also see it for milk per cow. We see that there's some upward relationship, but it is quite shallow, and we see wide grey bands, shaded area of the confidence interval, telling us that the relationship does exist, but it's a little bit loose, especially when we look at the distribution of dots as well across the graph. Each one is a farm. What we see is that there's a lot of variation. It's like this was like actually when I went duck shooting last weekend. This is what it looked like, except the duck was outside of the graph. This is what my shotgun, but the duck was well outside the graph most of the time. I'd like to say that, Phil.
And which of those dots represents the Blues rugby team, Graeme?
The one right down the bottom. But the other one, we had 2/3 of the people surveyed, Phil, highlighting the importance of operating expenses, and that really is the main driver we find within it, of course, the operating profit margin is a combination of gross farm revenue and operating expenses. But the biggest thing that drives it, we find in our work, is the operating expenses, the ability to really record our costs, benchmark our costs, and think carefully about their management. And we know that cutting out cost is, you can get too focused on cost. If you take too much out, it can harm our resilience. We can lose body condition score. The supplement we buy might not be of a high quality, but it's just an overall focus on trying to be careful about the cost of production on farm. And once again, it is a key driver of that operating profit margin, which is, as I emphasized earlier, is a very important metric. And the last one I'd like to show tonight as well, Phil, is here. The relationship is not as strong, but what we see is this upward relationship between higher levels of pasture crop eaten and higher operating profit margins. And this is a story that, this is a kind of a key principle of profitable dairy farm management in New Zealand that we've heard for many years. And based on our recent analysis, it remains as pertinent as ever. And so I think I was really impressed to see the survey come through so strongly, because they actually had acted like they'd seen the answers, as we said.
Yeah, absolutely nailed it. And certainly the one that you had there prior to that, so the operating expenses certainly showed a marked change, didn't it? And we had two-thirds of the people picked on that one, and then pasture and crop eaten was the second one, which has also got that better change, and the other third of the people chose that one. So well done to everybody taking part. We do have one question in the Q&A, Graeme, from a little bit earlier on in your presentation. It says, where is profit going to increase from regarding environmental constraints that you have mentioned?
Yes, I think there's two things there, Phil. Sorry, I'll just write it down so I can...
So where is profit going to increase from regarding environmental constraints that we've mentioned?
Do you know, what I think we find here is, we've just highlighted as a group, and the group picked it up very well, is that what drives operating profit margin, which is strongly related to operating profit, of course, is operating expenses and pasture and crop eaten. And I think as environmental limits, both from the water quality perspective and the greenhouse gas perspective, as they start to really impact our farms, the two ways we can increase profit there are by cost management and pasture and crop eaten, and they're related, of course, because reflecting on supplement and the utilization of pasture are very good ways of increasing our efficiency. If we can do those things, so really it's a bit of a logic flow here, is that we try and, if we focus on our operating expenses and our pasture and crop eaten, that allows us to improve our operating profit margin, which gives us greater environmental efficiency, as I spoke about earlier. So increasing the dollars earned per unit of nutrient loss, or per unit of ton of carbon dioxide emissions.
Yep. And no doubt you will have seen, Graeme, in the same way that I have with the work that I do around finances with dairy farmers. But we're not sort of trying to get farmers to make one or two major changes on the farm, are we? It's more of a little change over a number of things. The cumulative effect over a period of time is quite powerful. Yes,
I honestly feel that's a great point. It's it's really the thing that that really motivates me, and why I do the job that I do, is that environmental limits, they are a limit, and they constrain us what we've done in the past. But what they actually also do is start us evolving in a different direction, and that's an exciting direction. It is a difficult journey, but evolving in that direction, incremental changes really focused on efficiency. How can we improve efficiency? We saw earlier that we had 30 years of quite stable efficiency growth. Efficiency was stable, it was flat basically. And I think now it's really our chance to, environmental limits might be the catalyst that really drive us towards 1%, 2% a year improvement, which we probably need in the long term if we're going to maintain our international competitiveness.
Great, fantastic. That's all the questions that we've got in the chat for the time being, Graeme. So what we might do is, unless someone has got one they want to throw in there in the next sort of 7 seconds or so, we'll move to Mark's presentation. And Mark's going to, as it says there, international dairy competitiveness. Now, Mark Neal is a dairy systems specialist with DairyNZ in the economics team. While in research and development roles, Mark has worked with economic modelling and optimisation of farm systems, farm system design, and quantifying the impact of environmental regulation on farm profit. Mark's family has 2 dairy farms in New South Wales and Australia, milking a total of 1,100 cows between them. And you will understand as soon as Mark starts speaking that he has obviously previously managed those operations. And Mark has also managed operations of grazing-based dairy farms in Chile and the United States. Mark Neal, the floor is yours.
Thanks, Phil. Yeah, so I think it'd be quite interesting to get the view from the audience. Who do you think out of the countries is most competitive? So Hamish, if you're, yep, you've got that up there. Who's got the most competitive dairy sector at the global level? Australia, Ireland, or New Zealand out of those 3?
I presume you'd like at least one person to vote for Australia, Mark? Would that...
It might just be a sympathy vote, Phil. Well, that's fairly conclusive. So obviously the audience have got an idea of what they think competitiveness is or where they think it sits, Mark. So how do you define competitiveness? Yeah, so I would tend to agree with the audience here. I think New Zealand is doing a very good job in this space, but it is a good point to keep an eye on what's happening internationally. And Ireland is making some progress, as we'll see shortly. But what do I mean by competitiveness? So a bit of a working definition we've got is, first of all, the dairy sector needs to provide what the world wants. And so that covers the notion that you're competing not just against other producers of dairy products, but potentially substitutes for those dairy products or items people think are a substitute for those products. And when we're talking about what the world wants, we're thinking about, the quality and the price of those goods, but also the other attributes in terms of, it might be, credence, what we loosely call credence attributes, like what's the environmental impact of this, or, how confident are we in the supply chain, etc. So that's the first part, providing what the world wants. The second part of that is making sure that we've got a decent return on all the capital, labour and other inputs. So we're competing on the customer side, but we need to make sure that our land earns us a decent return, our capital, our labour, etc., etc. Otherwise, other sectors will be able to attract those skills and resources to their sector away from dairy.
Yeah. Look, Graeme talked a little bit earlier on in his one about the trend in New Zealand operating profit margin. How do you see how has the US sector been changing?
Yeah, and the US sector is a really fascinating one. So we were just looked at the grazing grazing-based sectors, or the primary grazing ones, Ireland, US, and New Zealand. Ireland, Australia, and New Zealand. But the US is, it's a very fascinating beast. So the trend in their performance is quite interesting. But before we get to the trend, just to get you a quick overview of how New Zealand and US compares. So total dairy cows in New Zealand, roughly 5 million. In the US, 9 million. So nearly twice as many in the US in rough terms.
farms, so 11,000 in New Zealand versus 30,000 in the US, so basically 3 times as many in the US. Cows per farm is an interesting one. We think of large US dairy farms, but the average, New Zealand, it's 440 cows. In the US, it's 300. So average cows per farm is only 2/3 the size. The other aspect, and if we get into the production side, so again, the cows we've already talked about, twice as many cows, but the milk solids per cow is basically twice as much. So 380 in Australia, 380 in New Zealand versus 760 in the US. Obviously coming from, a larger cow, larger frame, TMR diet in general. And so what that means for the milk solids, so New Zealand about 1.9 billion and the US 7.2 billion. So they've got twice as many cows producing twice as much milk per cow. So their total volume of milk is about 4 times as large. So that's basically where they're sitting at the moment. The really interesting thing for me is thinking about the dynamics of how these things have changed over time. So, for example, in New Zealand there on the left, if you index this back to the same point in the year 2000, so New Zealand's cows over that time have increased 40%, but the US, the number of cows has barely shifted, which might be surprising to some people. Okay, well, that's the cows. What's happened to the farms? So in New Zealand over that period, the number of farms has reduced about 20%. That sort of hides, a shift in terms of, maybe less farms in traditional areas, more farms in the South Island, for example. But in the US, the reduction in farms, that's 60% less farms over 20 years. Wow. And that's a huge structural adjustment. So that's cows and farms. What about cows per farm? So when you think about how the cows and the farms work together, so in New Zealand, the herd size has gone up 75%, but in the US, it's gone up, nearly 160%. So more than doubled over that period. And so that's not just doubling on every farm, that's a loss of smaller farms, and the farms that remain are either bigger or some new farms enter that are very large. So that's the cows, farms, and cows per farm. If we want to think about the milk solids, how that's tracked, so again, the cows as we had before, if we think about the total milk solids, so in New Zealand, there's been a 73% increase in total milk solids, and in the US, 42%. So New Zealand over that time has had a larger increase in total milk solids. But where did that come from? So in New Zealand, there's been a 23% lift in milk solids per cow, and then more cows to get to the total. Whereas because the cows have been quite static in the US, the cow numbers, the milk solids per cow is basically responsible for all increase in total milk solids. So structurally, that's a very quite a different picture. Now, if we think about large farms, we have if we think about large farms, which are, say, more than 1,000 cows. So both New Zealand and the US in 2020, about 5% of the farms were large farms, more than 1,000 cows. But now those large farms in New Zealand, they account, 5% of the farms account for 20% of the production. In the US, 5% of the farms account for more than half of the production. And that's because you have this quite skewed, there's almost a different category. There's large farms, and then there's, let's say, mega dairies, okay? And so the 500 largest farms average 8,000 cows each. And indeed, if you took the top 1,000 cows, the top 1,000 farms in the US, they probably comfortably produce more than all of New Zealand's 11,000 farms.
So what's driving the move to the larger farms then? Like, do we need to be looking to increase our farm size to remain competitive?
And that is a very good question. So if we look at the economics that are potentially specific to the US, so this was from a report done in 2016, looking at economies of size for the US. And so what you have on the right there is you've got farms, say up to 500 cows. Most of those, and the blue line is the average profit, and then the blue shaded area covers 95% of the farms. So most of the farms under 500 cows are losing money because that blue area was above the green line, which is their revenue. So if your costs are above your revenue, that's bad news. And that speaks to why there's been such rapid structural adjustment. Indeed, Wisconsin, a traditional dairy state, the last few years have been running at 10% less farms per year. So really, really radical adjustment. And while that curve does flatten out a little bit, as you head over to the 1,000 cows or more, or even 2,000 cows or more, most of those farms, their costs are below the revenue line. So they're making a profit, or most of those farms are making a profit. So there are economies of size as you get bigger farms in the US. And so for an example of what one of these mega dairies looks like, this is one of the biggest, the Fair Oaks farm in Indiana. You can see a picture there of the complex is, quite massive. So 40,000 cows, all inside, 450 staff. That's a lot of birthday cakes per year. You could almost assume you're going to have a birthday cake for lunch.
Yeah, you wouldn't want to be letting your staff have their birthday off on holiday. You'd always have
so 65 tankers full of milk every day. Cow intake 45 kilos a day, so easily twice what you'd find the average farm here doing. Silage is going to be 2/3 of the total cost of the ration. Lots and lots of maize maize silage going into that diet, and 100 calves born daily, but every day. And they're actually quite an open facility that they have a lot of visitors come through. More than 500,000 a year. So they're quite open about what they do. In summary, what we're seeing in the US is less farms, and it's probably averaged nearly 4% less per year for probably 3 decades, and moving away from traditional regions, so the Northeast, that sort of Wisconsin part of the world, and away from smaller farms, obviously, away from pasture, so a lot less pasture in the diet or farms that use pasture. Again, towards higher production per cow. Those larger farms tend to have higher production per cow, which is not necessarily the case in New Zealand. And these large, efficient farms, which is why we do need to think about them in the competitive sense, is they've had a positive trend in operating profit margin, whereas from what Graeme showed earlier, New Zealand hasn't had that trend. So yes, it is is something to keep an eye on. But should we be following what they're trying to do here? So this is the dairy-based data for 2 regions, Marlborough, Canterbury and Waikato. And while you do see some economies of size heading towards, say 300 cows, when you can quite efficiently utilise 1.5, 2 labour units, beyond that, you don't see the strong reductions that you do in the US. and it seems quite likely that there is a point at which it does become less efficient. And we don't have a lot of farms in that category, perhaps for quite sensible reasons. And indeed, it lines up with work that, for example, David Becker has looked into this over a decade ago, and came to similar conclusions based on the data he'd looked at the time. So no, I don't think we should assume that size is something that we need to chase just because the US system is doing a good job at improving efficiency from that pathway. So, well, for me, some of the takeaways from that part are that we shouldn't try to be the US. Milk solids per cow doesn't equal profit, and Graeme showed that as well. We don't really think there's economies of size in pasture beyond a certain minimum size. And if we speak to our competitive advantage, basically as per what Graeme was talking about, high pasture harvest is important, definitely our low cost per hectare, and being clear about the value of additional capital. So if we are going to invest more, what is going to be the value that we can reap from that?
Yeah. So if pasture is so important, which countries are making progress in that aspect?
Well, and this probably doesn't come as much surprise given what we've seen from Graeme earlier, but New Zealand is not making much progress in the pasture trend. So this is on the vertical axis, you've got pasture harvest over time. So it's 15 years worth of data there, or slightly more, and you're not seeing a positive trend there at all. Or you'd be pretty optimistic to say there was, to be honest. Certainly not statistically significant. But it's at a high level, which is good news, because one of the alternatives is if you're in Uruguay or Argentina, that you're not making progress, but you're stuck at a much lower level. So definitely better to be in the New Zealand camp than that camp, but making progress would be even better. If we look at Australia, basically not making any progress really, or at least the Victorian part of Australia. Ireland, though, has really made a lot of effort in this space to really be competitive in the dairy space, and they've made great. They've had a lot of focus in this pasture space. And then a couple of interesting ones. Tasmania, is actually a part of Australia that is making significant progress in pasture harvest. And then South Africa is quite an interesting one that probably we don't think about a lot, but over, the slope of that line shows quite a steep rate of progress, even more so than the Irish. So they have really put the pedal to the metal on that, and getting close to the levels that we see in New Zealand. So, it is possible to make a lot of change. That's Ireland, Tasmania and South Africa have shown that you can make progress in a relatively short space of time. New Zealand might be a lot closer to its potential already, but we do need to think about, if we're going to make progress, how are we going to go about that?
Look, very impressive improvements, as you say, there in two or three sort of regions. But if their pasture harvest is growing that quickly, what's happening to the operating costs at the country level? Are they doing the same thing, or what's happening there?
Yeah, okay. So with the operating costs, so here's a number of countries, and you'll generally see them trend up over time with inflation, for example. So it's not unsurprising to see an upward trend. Like this data hasn't been corrected for inflation. It's in US cents per litre of energy-corrected milk because, we're trying to do an international comparison, and it can be a bit tricky to, choose what's the right metric to have a fair comparison. And this is probably as close as you'll get. But in this picture here, so New Zealand, while it's been having that trend with inflation, the slope of that line is flatter than many of the others, which shows, some reasonable constraints on expenses. Whereas in other places, Argentina, Uruguay, Australia, the slope is higher, so that's less of a focus on cost control. So South Africa, who we talked about having a good focus on the pasture harvest, have also managed to have a lower rate of gain in cost than New Zealand. So they're still higher, but the rate at which they've increased has been less. A couple of other countries of interest. So the US, interestingly, is their trend in the increase in costs has basically, it's the same slope as New Zealand. And then the only one that's really bucked the trend is Ireland, as they've managed to, a lot of volatility around it, and obviously constrained by quotas in earlier periods, but they've managed to sort of buck the trend and have a downward trend. So yeah, a real focus that they've shown in that space. And there's a whole bunch of things happening in Ireland. They're obviously have intensified, the mouths that are eating grass on their farms have traditionally been quite a mixed group of animals, but more and more that they've concentrated, onto dairy animals and got rid of some of the beef animals that were maybe not contributing as much profit or helping them harvest as much feed as they could.
Mark, you had a very pleasing slide there a couple back showing that New Zealand certainly knows how to grow pasture, but as a result, we also have higher land prices. So how do you account for that across the countries?
Right, and that is a tricky one. So we think of pasture as a cheap feed. However, you have some people say, well, that's actually an expensive feed because of the cost of the land. So how can we try and take that into account? So some work done with David Becker and the Irish, we looked at an economic cost, and what we've done here is we've included a lease cost of land for the land asset and an opportunity cost of capital for all the other capital that's involved. And this is potentially a little bit concerning because that does close the gap. It does close the gap between New Zealand and some of these other countries. And the US, for example, that line there is the average. And we've seen that there are potentially some quite efficient farms that are performing much better than the US average. And they're probably the best farms from the US are probably approaching the New Zealand average. So I think that is, something that we should think carefully about. While places like Tasmania and Australia, the economic cost is not much higher, their capacity to produce more is, somewhat limited, and hence that will have less of an impact on international markets. Ireland still has some capacity potentially to increase, and they are quite, they're willing to work across all markets in the world, and so they are to some extent a competitive threat. But I'm more concerned myself around the US. At certain prices, at certain levels of efficiency, they can create a lot of milk that's hard for international markets to suck up. So I would say that the so I would say in summary, the US sector is quite competitive, but copying is not really going to be the answer that we're looking for. It's that keeping that triple focus on pasture harvest costs and being disciplined with capital investment, and really looking for those opportunities on farm or through research, development, extension to maintain and or push that competitive advantage going forward.
Great stuff. Thanks very much, Mark. Yeah, so some very good stuff in there. A heck of a lot that I didn't know. Fascinating about the 40,000 cow farm and 600,000 visitors a year. That's, as you said, around scale, that's some pretty eye-watering numbers that they're starting to talk about there. We do have some questions in the Q&A here, basically for both you gentlemen. I'll run through the ones that are addressed to Mark first because we're just still on his topic. Yep. And we've got one here, some big words in there, I'm going to have to concentrate. To what degree does precision fermentation or synthetic dairy threaten our dairy industry? Any feedback on that?
Yeah, so that is a really it's something we really need to be across, is understanding to what extent that those technologies can scale in the medium and longer term, but also understanding what their what the economics of that looks like. All of those synthetic alternatives, if you like, do require a feedstock of some type, and so where it comes from a crop, you've still got the cost of the crop. Where it's got to be fermented in stainless steel, you've still got the cost of the stainless steel. And it is going to take time to see how that scales over time and what the consumer acceptance of some of those things are going to be. For example, like I believe at least one of the products requires a microbe that's been genetically modified to create the the proteins that are in the final product. To what extent will people accept that in the short to medium term? What does the taste like? What is the quality like? So it's certainly not something we can dismiss out of hand. It's certainly worthy of further consideration.
And I think a nice addition there as well, Phil.
Yes.
We were at the Farmers Forum last week, and a Fonterra staff member there spoke about the market, what the market is demanding from dairy milk, and talking about the premiums that New Zealand milk is already receiving in the global markets, and also the future potential for that as well. And so that was one point when I spoke about when I answered that question before, that was one thing I missed out, was really those opportunities for us to receive a higher market price because of our focus on natural production of dairy milk, as in relation to industrial dairy solutions such as those based on microbes.
Yep. Just while we've got you there, Graeme, there was one question came in specifically for you from earlier on. What do you think operating profit margin adds any more than simply looking at operating profit as a result?
Yes, I think because it makes it easier. If somebody was on the if somebody in the audience tonight said that they had operating profit of $2,000, I wouldn't be able to tell you whether that's good or bad, because it depends whether they're in Northland or Canterbury. It actually sends a different signal, or in Southland again. And so the operating profit margin is an easy way to compare across farms, across time as well. Yep. So if you said that you were earning operating profit of $2,000 now, or 5 years ago, it would be harder for me to interpret as well. But if I knew your operating profit margin was 0.25 in both years, or 25%, I would know that you're going okay. But if it was
So
Yeah.
that consistent operating profit margin would indicate continued control and monitoring of your costs, maximizing your income where you can, and basically turning as much of it into a profit as you possibly can while still doing everything you need.
Yes, and it's easy without inflation adjustment as well, without normalizing milk price. It's a very fast number that's easy to understand, that we know, we really know what it kind of tells us. I like it because it's quite easy. It's quite easy. Like it's very easy to come at efficiency from very technical and difficult to come at it. It's very easy to come at it and use very technical terms that are hard to understand, but operating profit margin is one number which which gives a very strong indication.
So there's just been another question pop up here, in addition to the question about operating profit margin, but Mark, this one's targeted at you, please. And you two can probably argue the toss about it, actually, to be fair. Wouldn't profit in relation to an asset, i.e. return on asset, be a better measure than operating profit margin?
I think Mark highlighted that in on his conclusion. I always think of it as Mark's 3, or the Neal. Sometimes I call it the Neal 3, which is pasture harvest, cost control, and disciplined capital investment. So return on asset's important. Return on asset is our gross return on asset is determined by operating profit margin multiplied by revenue divided by asset price. So it's actually a very important part of return on asset, but it's only half. The operating profit margin is only half of return on asset. The other half is gross farm revenue divided by assets. So that's known as the part of the DuPont formula. But yeah, I totally agree. Disciplined capital investment is just as important as cost control and pasture harvest.
Cool. Mark, anything else from you on that one, or Graham's covered it pretty well?
No, I think that's right. And one of the real tricks with return on investment is making sure you've got a fair value or a market value for assets. And if you are looking at that over time, do you want to just look at the operating return on assets, or are you also looking at the capital gain or the capital return on those assets? So it's it can get more complicated. In terms of growing wealth, then that is going to be driven by your total return on assets. But some of that is controllable, some of that is not controllable. So yeah.
So we've still got a couple of questions coming through, which is great. Thank you very much, people. Keep them flicking in there. Mark, you started your presentation. One of the comments on your one was around what the world wants. What about public perception on things like wintering on crops, bobby calves, etc.?
Yeah. So while there's a lot of maps that you'll see on the internet that don't include New Zealand as part of the world, within that frame, what the world wants includes customers and the public. And yes, there are there are things that we need to make sure that we're on top of to keep that social license, to keep that credibility with the public and with our customers.
And that's what I saw that last week at the Farmers Forum as well. Amanda Woodbridge presented some of our recent research from DairyNZ. She's our General Manager of Marketing and Communications. And what she highlighted there was based on a survey of the New Zealand public, that really some people do have a negative perception of the New Zealand dairy sector, but it's more around 10 to 12%, which is much lower than what some people perceive it to be. And it showed quite strong support for the dairy sector overall. There is a vocal minority, but overall we saw quite positive feedback, which was quite supportive for us, I thought.
Great. We've just got two left here, team. It looks like this one is, both of you again, but predominantly Mark, I would suggest. Given that the majority of Americans are not aware that their dairy products come from animals that don't graze pasture, is it likely that this will threaten their farming system once the public starts to become more aware and educated?
Yes, well, that is a great point. The pasture-fed means different things in different places. So, for example, there's some parts of Europe where I think it's 180 days or something. 180 days with some access to pasture counts as pasture-fed. So, what would the standard be? Whereby you brand something as pasture-fed or not pasture-fed. And so obviously, within New Zealand, we have an idea of what we mean by pasture-fed, but that's not necessarily shared worldwide. I believe there is growth in, pasture-fed milk within the US, but it's still a small proportion. Now, will customers change what they buy in terms of the milk brand, or is there the potential that some of those customers, rather than changing from a barn milk to a pasture milk, will some of them change to a milk alternative altogether? And I think they're quite open questions that the processors and the retail side would be working quite hard to understand more about those consumers. I couldn't tell exactly how that's going to pan out.
Yeah, fair enough. And one biting question just to finish with here, Mark. The national picture for your beloved Australia was great. Where do you think they may have gone wrong?
Well, I was anticipating that I might get something like this, so I did prepare something earlier. If you ask me where did they go wrong, not only will I give you a year, 1985, I'll also give you a date within March. So this was the Australian Society of Animal Production and the New Zealand Society of Animal Production joint conference in Australia, and they were focused on what the US is doing. One of the keynote papers, The Future for Australian Dairying, Alternative Systems of Production, was highly focused on the US. And one of their figures here was, well, look, the US is doing 5,000 litres per lactation, and New Zealand and Australia are only doing, 2,900 litres per lactation. We need to close that gap. And, this is the graph that was in the paper. And so, okay, right, they've started on this premise. So what happened? So since then, in Australia, there was a compound annual growth rate of 2% in milk per cow, which is great. But because the number of farms have been decreasing by 3.5% per year at the same time, the difference in milk has been virtually nothing. And indeed, most forecasts that you'll see for Australia will have declining levels of milk production as the default scenario. So, there was a point, or I might say 20, 25 years ago, where Australia and New Zealand produced exactly the same amount of milk. And Australia, since that point, has declined a little bit, and New Zealand has, doubled. And you could argue the toss about, whether the gap should be that big. The reality is that it is, and that indeed the Australian dairy sector is busy going through a bit of a post-mortem now as to what went wrong, and that is that's my 10 cents.
It's great to see that you're always prepared for one of these supposedly curly ones at the end there, Mark. They always come out, don't they?
Yeah.
I did think for a minute there, though, the way you were being quite specific about the date, I was starting to think, was that the day you actually left Australia? But not quite that far back, is it?
No, we probably subscribed to the New Zealand dairy exporter probably about that time. So yes, that certainly shaped a lot of our thinking. While a lot of people, tried a very different path. Yeah.
Just glad it wasn't his birthday, Phil.
I was starting to worry for a moment.
Is it your birthday, Phil?
No. So I will just I think Henny Mayer has come out in support here. I think for you, Mark, he says they may not have the cost structure, but they've got the animal quality. We have to give them that. Is that related to Australia, do you think?
I'm not sure. Yeah.
Hey, look, I think that is our time, ladies and gentlemen. And I think in fairness to those that have enrolled and registered in for this evening, I think it's only fair that we keep as close as possible to time. So I've just written a couple of notes here just as a very, very quick summary. But firstly, I would like to thank Graeme and Mark for your presentations this evening. Thank you very much, gentlemen. Graeme, some great insights around the drivers for focusing on improved profitability. And Mark, some extremely useful data there, I thought, around competitiveness from scale, the dangers of New Zealand trying to copy others. We need to concentrate and understand on what our competitive advantages are and concentrate on them, don't we? So, concentrate on what we can do, not what the others are doing. So, and of course, we'd like to thank you all as participants for joining in with us. We trust that you have somehow in those presentations and questions got some good information out of it, something that will help you have some solid discussions over the farming future for you and certainly for New Zealand in general. So thank you very much for your attendance, and we wish you a very good night.
Thank you.
No, thank you, everyone. Thank you, Phil.
Thank you.